Elon Musk and Tesla just dropped the hammer. What a move they just made. I want to run through with you guys what Tesla has decided to do here and why it is so dang meaningful. And this is a massive, massive move. So I'm going to share that with you guys in this video here today. Then we're going to get into this one. Retail investors shouldn't touch China stocks. I think this is an important video because a lot of people have seen, other than really like the past 24 hours, but over the last week or two, there's been so much money to be made in Chinese stocks. A lot of these stocks have gone up 30, 40, 50%. A lot of people are wondering, should I get in these plays? So we're going to speak about that in this video. Hard for market to sustain a sharp sell-off with current tailwinds. Looking forward to reacting to this one, kind of sharing my opinions and perspectives there. And then last video up here, bullishness prompts questions of what's priced in the markets. I think this is an important subject, so I thought we'd react to that one here today. I appreciate everybody joining me as always. Thank you everybody that smashed that thumbs up button. I appreciate each and every one of you. Additionally, thank you everybody subscribe to the channel. 51,000 plus subscribers now. New all-time high in the history of the reaction channel here. So I appreciate each and every one of you for being here. By the way, pin comment down there today if you're looking to apply, join a private stock group, private wealth group, as well as get access to 1000xstocks.com. Alrighty, so Tesla, huge move by them. And I mean, absolutely massive. They're now giving on the Model Y 0% APR. Now, this is a pretty huge move. Now, the key, there's a few keys in regards to this, okay? One is not everybody can get 0% APR. You do have to have good credit. Additionally, it is not just a Model Y they're doing this on. They're doing it on the Model 3 as well. Both their mass market vehicles. Now, also something very important is you see right here, 0% APR with purchase of full self-driving supervised. So it is clear Tesla's really trying to push this as well. But I mean, you go ahead and you start taking a peek at the, let's be honest, a lot of people finance these vehicles. You start looking here and it's funny, excellent 720, shouldn't they have an 800 option here? I mean, if we start talking about 0% APR plus you're getting all these tax credits and whatnot, that's a pretty shocking thing, right? That's pretty darn shocking. So it's clear that Tesla really wants to push FSD, which I think is a genius move by them. And anytime you offer 0% APR on anything, it's going to get attention. This is going to get a lot of people on X talking. It's going to get a lot of people sharing this around. 0% APR, no doubt about it, right? And so huge move by them. And they've been moving in this direction of really pushing rates big time. You got to understand, if you want to go get an auto loan from just about anyone else right now, you're likely paying at least 6% plus, but you could be in the 7s and 8s, if not the 9s, to go get an auto loan on a new auto right now. So when all of a sudden somebody says 0%, I can tell you in this interest rate environment, if they were doing this a few years ago when interest rates were on the floor and it was very commonplace to be able to get an auto loan at 2-3%, that's a different situation. If you said 0% APR at that time, wasn't as big of a deal. Right now, huge deal. So this bodes very well for Tesla's delivery numbers. I can tell you for this quarter we're in right now, I think this is going to definitely attract a lot of attention. It's going to help push sales into a better place. And I got to say, I was pleased with the latest delivery numbers and production numbers. Obviously, we want to see them grow a lot more than what they grew in the quarter, right? But it's good to see things getting back on the right track. And just, I wouldn't want to compete with these guys, man. It's brutal. I mean, competing with Tesla is just brutal. I would not want to compete with them. They don't care about margins in the short term. They don't care about a lot of this stuff, right? But keep in mind, if you get FSD, that's a great margin for Tesla, because FSD, I'm just going to be honest with you guys, it doesn't really it's not like this an additional big cost to Tesla. So I think that's fascinating. By the way, I will say one more thing about Tesla here before we move on. I got to say, their software is so vastly superior to others in the market, it's not even funny. I experience these other folks' products out there, and I just realize how bad the software experience is. Tesla does so many things that make your life so easy that you don't even have to think about, right? It's I went to the gas station in the new car today, right? And I wanted to get a soda, so I went in there and I got the soda, and then I came out and I realized, oh, I didn't lock the car because, I actually have to pull out a key and lock the car. You don't have to do that with Tesla. Your phone gets near the car, it automatically opens for you. You walk away from the car, it automatically locks itself. You don't even have to worry about these things. And once you get spoiled by all these little things Tesla does, it makes your life so easy. Like literally, if I walk up to the Model X door, the door opens for me. I don't even have to touch the door. And then I put my foot on the gas pedal, it closes itself. Like there's so many just these little things that make you a lazy little fart being a Tesla customer. But then you take that away and all of a sudden you're like, oh, like these other companies really suck at this. Like their maps product is so vastly superior. Like I got the satellite maps in the cars on the big screen. It's beautiful how it's all laid up. You need to navigate somewhere. It's just a gorgeous experience. You go to these other auto manufacturers and it's like you feel like you went 20 years back in the past. Like you're like, what is this, dial-up internet? Like holy smokes, man. The lag times on these other companies competing products, like on the software side, like Tesla's a million miles ahead of the competition. It's not even funny. All right, so let's go ahead. Let's start diving into these.
Plunging more than 9% overnight. Its worst day since 2008 after China failed to announce any major stimulus plans on the first day of trading after a week-long holiday. Our next guest thinks retail investors should completely avoid China. CNBC contributor John Rutledge is chief investment strategist at Safana. John, always great to see you. You think this whole thing was a head fake? You don't believe the stimulus will have any effect?
No. Li Jiang is trying to hit their 5% growth target. They're not going to make it. They have terrible real estate problems. Pay offers are going down. Home prices last month fell 5%, biggest number since 2015. They have to find a way to stop that real estate deflation. And without that, all they can do is small moves from the central bank, half a point on the interest rates and a tiny move in the reserve requirement. And they're throwing half a trillion RMB, which is like $30 billion at the problem. Just not enough. And an investor, to me, is someone who's hanging in for the free cash flow stream, not for the moment. And so that free cash flow stream requires you to own something for more than a year. More than a year means you're only going to get the dividend in the next year. The rest of it are your hopes and prayers. I think that as long as Xi Jinping is running the place, he'll keep teasing investors with bring your money, and then he'll do something to drive them away again. And they're doing that right now.
What do you think is the heart?
He's honestly, he's right in my opinion. Absolutely. He's right on in regards to that.
Part about the real estate market to fix, and the thing that maybe is the most misunderstood by Western investors. I mean, I'm wondering because, you think about, for instance, the ghost cities in China, and a lot of those apartments were paid for in all cash by average people who are looking to invest. They're empty. Yeah. They're still empty. There's no infrastructure around these apartment complexes. But what can be done to make people feel like that investment has paid off or is gaining in value? I mean, it's just an asset that's sitting out there that can't be liquidated.
It's a great question, Melissa. Their wallets are empty too, their bank accounts. And so there's nobody out there to buy them. In the announcements they made week before last, the central bank announced they were going to do something to allow first-time home buyers to have a lower down payment, 15%. They were doing something to allow local governments to help people buy houses, first-time home buyers. But those are tiny things in a market that's vastly overbuilt. And those apartments are not going to go away. So when you build an economy based on purely real estate inflation, it takes a long time to unwind it. And during that time, I don't want to own Chinese stocks. Partly because of that, but mostly because Xi Jinping can wake up in a bad attitude one morning and take it all away from you by picking up the phone. That's not a place I want money.
So I agree with him in regards to Xi Jinping and his thoughts there. But where I actually disagree with him is I think, and am I going to make a bet on this? No. But I got to say, the Chinese stock market, in my opinion, is actually set up great for the next 10, 20, 30 years. Here's why. If you think about everybody being so dependent upon real estate and asset appreciation in the real estate market, everybody in China, boom, they got slapped in the face, right? And all of a sudden they realized, man, because you got to understand, like this gentleman, he almost makes it sound like everybody's poor in China or something like that. No, there's a lot of money in China. There's a lot of wealthy folks in China, and there's a massive middle class in China. And I mean, absolutely massive, okay? So don't get this like perception of like there's no money in China. Like I'll take you to in Las Vegas. We'll go to the Encore and we'll go to the high limit rooms. And you tell me how many Americans you see in there and how many Chinese you see in there. And then you'll begin to understand that there's a lot of damn money in China, okay? Never mind, we could go to Macau if you want to go to Macau, and you really have your eyes open a little bit. So this notion of like China doesn't have money, these people don't have money, not true. But what I think is going to transpire here in their financial markets is I think people are going to be not as like, oh, let me just go buy another apartment, another apartment, another apartment, another apartment. Let me just go buy more real estate. As they make excess money, I think they're going to be more incentivized to put in the stock market over the next 10, 20, 30 years. That's going to be a process that builds out. And if China wants to become a massive player in the financial world, I'm telling you, they've got to make their stock market investable for not only their own citizens, but other citizens as well. That stock market has to start being respected as like, that's a major stock market that you would feel comfortable putting your grandma's money in, your kids' money in, your money in. If they can do that over the next 10, 20, 30 years, I think China will be respected on a whole other level when it comes to economically. And I think that's actually a decent probability. Could Xi Jinping screw it up? There's potential, but I think a lot of their citizens are going to say, we need to diversify out of just real estate. In cash, we need to also be invested in the stock market.
And with that backdrop, what are the likelihood of something bad happening with the Philippines, which has been in the news recently, and or Taiwan, which has clearly been in the news for the last 3 years?
Well, Guy, Taiwan's the big question. Nobody knows the answer. But Xi Jinping wants to get that done while he's still alive, and he's an old guy, so he doesn't have too long to make it work out. There's discomfort inside the party among the older members of the party.
An old guy? Sir? Have you seen the last two presidents?
And the military is not really very tightly organized at the moment. We can see that from the people that they've pulled out of key positions. So they're not in a spot where they can do that. The Philippines, they can make a lot of trouble there and all over the South China Sea, and there's not much we can do about it because we're stretched between Ukraine and Israel, and we're not paying much attention to what China's doing out there.
John, what we saw today also is sort of China's response to increasing tariffs being put on their products around the world. We saw them put retaliatory tariffs on brandy, for instance, out of Europe in response to Europe's taxation of EVs. How far along does this go, and how do you see this playing out next year after the elections? Because either administration looks to have sort of a very tough view on China.
Absolutely. The Economist has put out estimates of the amount of tariffs you'd get from these two candidates, and they're both really big. Trump's are even bigger, and they put a real dent in trade. To that extent, they put a little bit of upward pressure on prices here, but they also reduce growth there. And so I think that tariffs are going to be in the news big between now and November 5th. But after that, they're going to recede a little bit because the political payoff for rattling the cage on the tariffs is much lower after that. But trade with China is going to be tough, and the tech trade especially, because the more we worry about national security, the less we're willing to sell them these fancy chips that you folks were talking about.
Yeah, so that gentleman just way too pessimistic, way too bearish on China, in my personal opinion. Ask Tesla about how the Chinese market is. Like, I would say at least 25%, if not up to 50% of Tesla's value is because of the Chinese market, because of their Shanghai Gigafactory and all the revenue that brings in, whether on the energy side of the business, the services side of the business, the amount of vehicles they make there. Massive market for the company. So, I think a gentleman like that can give you a very false perception that the Chinese don't have money and that they don't know what they're doing and blah, blah, blah. I just think he was way not fair enough. Not fair enough at all. I can tell you, I own plenty of stocks that are heavily reliant on China. Like literally, if the Chinese market was eliminated tomorrow, like Tesla's stocks down easily 25% the next day, if not 50%. Like, it's that dramatic with how important of a market that is for many of these major companies, right? Now, is it the biggest market for like a Meta or something like that? No, Meta, Google, those sorts of companies, they're pretty much non-existent in China. They really have no meaningful business there. But then you look at somebody like Apple, significant business for Apple in China. Significant, not just in terms of the hardware side of their business, but the services side of the business. Massive. Like if China was to be eliminated tomorrow, Apple stock's down 20% plus the next day. It's just a huge opportunity for them. So, alrighty, next one up here. Hard for markets to sustain a sharp sell-off with current tailwinds.
With our market panel, Adam Crisafulli of Vital Knowledge and Charlie Babrinskoy of Ariel Investments. It's good to have you both. Adam, I'm going to kick things off with you because we did have a relief rally here in the major averages, but not a whole lot has necessarily shifted for the narrative. So what gives?
Yeah, so I think you kind of have this tug of war that the market's been in now for the last couple of weeks, whereby you have these four very powerful tailwinds, the most important of which is stimulus. So that includes central bank cuts around the world, pretty much everywhere except for Japan, alongside what China just did in the last 2 weeks. So you have stimulus, you have relatively resilient growth. We've had some pretty healthy economic data in the U.S., disinflation, and then reasonably healthy corporate performance on the earnings front. And those four tailwinds are running up against very rich valuations. And so you kind of have this battle. The result is the S&P moving somewhat sideways. It's been kind of caught in this very tight range now. But that's really what we've been doing. And it's a tug of war day to day. On certain days, the elevated valuations leave the market more exposed. Some of these exogenous risks that we've been seeing, either geopolitical or in the political front in the U.S. But it's really hard for the market.
So, you know what just caught my eye there? There should be something that also catches your eye when you see what you see in front of you right there. What it is look at the Nasdaq and look at the Russell. Russell, this is back to the playbook of 2023, is it not? The playbook of 2023, Russell sucks, small cap stocks suck, and big tech's phenomenal, right? And that's exactly what we've seen play out here. So it's interesting. We're still playing the same playbook of 2023 here at the end of 2024. My hunch on why that is occurring is really around rates, right? And we have seen, especially the long end of rates, move up. And so I think because of that, you haven't seen the real push you thought you would see in Russell, especially if we're not as confident about the Fed lowering rates in a substantial way. So where do people pile back into? They pile back into big tech. They want to be in Meta. They want to be in Nvidia. They want to be in the big guys. And so the small guys just kind of sit there floundering. And I mean, it's a great day for the Nasdaq. If you own big tech stocks, it's a great day for your portfolio. And my portfolio was great today, right? Up 1.62%. Public count outstripped the S&P 500. It destroyed the Dow, destroyed the Russell, and it beat the Nasdaq today. I can bet you that a lot of those gains were what? Palantir stock, Meta stock, probably Amazon as well, right? And so, that's that.
Sustain a sharp sell-off with those four tailwinds still in place. And I think this is going to be the pattern going forward. The bias will remain to the upside, but it won't be easy because valuations are extended.
Charlie, want to get your...
By the way, Palantir, I did a video on Palantir stock earlier today on the channel, if you want to check that out, if you're into Palantir. And additionally, I think it was yesterday or the day before, I made a super in-depth video on the main channel, Financial Education, around Palantir, where I see the stock price going from here, valuation, do I think it's still a good deal or not, all those sorts of things. That was on the main channel, Financial Education.
On that, especially as we do see a U.S. economy that is holding up. You have a Fed that's beginning to cut here, but as Adam just mentioned, you have valuations that are rich, you have positioning that is stretched, and you have a lot hinging now, it would seem, on Q3 earnings.
Yeah, those valuation metrics tend to be good predictors of long-term performance, not such good predictors of short-term. The market can seem to stay at lofty levels for a long time, but in the long run, the best predictor of long-run returns are current price-earnings multiples, and those are absolutely extended for large cap.
That's wild. For large cap, exactly. But not that crazy for a lot of those stocks. SMCI's down, like what? SMCI's really down to $45. No flipping flapjacking way. I can't even believe it. Like what? $45 on SMCI? This is insane. So let's pull up a year to date of this baby. This is crazy. 45. So it's now down from the peak here. It's now down 61%. Jeez, it was actually even lower than that. Got down to 39. That's just wild. Like I'm just like, that's a crazy number. I was surprised when I saw that. Like I understand they're going through a lot of stuff right now. It's no bueno.
Just have to recommend and remind that you can't just say the stock market. We have value stocks trading at much more reasonable levels,
Yes,
very
that's
close
true.
to their historic averages. The gap between PE multiples of growth versus value are at historic wides.
Sure.
So we would say, yes, the large cap tech sector is stretched and probably in the long term not going to produce great returns. Small and mid cap value is still reasonably priced.
True. I agree with that.
What should investors do with China here? There's some disappointment that the stimulus, at least chatter about it, doesn't seem to be going as far as some hoped. And we saw a big sell-off in some Chinese markets over the last, several hours. Was the excitement overdone, or is this just a bit of a speed bump on the way to continued upside?
I think it's more the latter. The velocity of the move that you saw in China was unsustainable. In any market, you have just this enormous rally that occurred over a very brief period of time. But if you really look at what they've done, they're pulling some very powerful levers on the fiscal front, on the monetary front, and then they're also changing a bunch of rules around the housing market, which is obviously an important critical component of the economy. And this is a real notable change from the government. You still do have this, the geopolitical angle where you have trade tensions rising between not just Washington and Beijing, but Brussels and Beijing and a lot of other countries as well. So the coast is far from clear, but I don't think what you saw was kind of a flash in the pan move. Again, in the immediate term, the rally did require a little bit of give back and some digestion, and we saw that.
The thing is very important everybody understands in regards to China and the stimulus measures and the quantitative easing, if you want to call it that, or whatever you want to refer to this as. The important thing everybody understands here is this could be just the start. Think back to the great financial crisis. Think back to the TARP program the U.S. government did. Think back to the early days of the government trying to bail out problems, right? That was just the start. And then came a money onslaught and the Fed making moves to help things out massively into 2009, right? So you see what's going on in China. Understand it could just be the first of many stimulus type measures the country does over the next year. So I think a lot of people are assuming like they made this move and that's all they do. Could be one of many moves over this next 12-month span, especially if they don't see the results they're really looking for here. So got to keep that in mind.
The policy changes are very powerful, so I suspect you're going to see further upside from China-linked equities.
Okay, now, Charlie, revisit for me, if you will, your strongest value narrative right now. There's a lot of uncertainty. There's this volatility. We've got an election coming up in just a few weeks. But there should be some things beyond that and into 25 that investors can sort of hang their hats on if they're kind of scheduling what they're going to buy and at what prices. Where are you seeing opportunities that are more than a few weeks long, but that are quarters long?
Yeah, I would argue that the relative inexpensive nature of value stocks is because people were very worried about a Fed-induced recession. People thought that the Fed was fixated on bringing inflation down by reducing the pace of the economy and reducing the job market. I think that is fundamentally been relieved. That concern is nowhere near as high or as justifiable as it was even 2 months ago. The economy is clearly has less likelihood of going into recession than it did even 2 months ago. And so the value stocks, which admittedly are more sensitive to the economy, are in better shape, and that's not fully reflected in their stock prices. The value stocks had a very good July, but gave a lot of it back, frankly, in August, and so are trading at a much more reasonable level, assuming we don't have a recession, which I don't think we're going to have.
Alrighty, next one up here. By the way, I thought this was important to point out. The snowball, right? Think about this. It's crazy. The public count up $39,000 today. It was up a Model 3 today. A Model 3. It wasn't even like it was some insanely great day for the public count. It's up 1.6%. And it was up a Model 3 today, right? It's just fascinating to kind of see the snowball. And, when the numbers get bigger and bigger, like how substantial it starts to become. Because, you see just a number, but then you put like a physical good, like, $39,000 could be like, a down payment on a starter house or something like that, right? Depends on what market, not in California, not in New York City, but some markets like $39,000 could be a down payment on a house, and that's just one day, one portfolio.
Vantage Rock's Avery Sheffield, welcome back.
Great to be here.
So you're not as bullish as some of the others who've been on the program here before you today.
No, I'm not. I mean, the market is expensive, right? 21 and a half times the S&P, 28 times the Nasdaq. cyclically adjusted Case-Shiller 35 times. It's actually almost the second highest. It's been back to the late 1800s. You have put-call ratios expressing extreme bullishness. This is a market where people are excited, as your previous guests, who I greatly respect, I think demonstrate people are excited. And when everyone's on one side, I always wonder, is this really...
Everybody's not on one side. I got to be clear about this. That's a myth in regards to this. I reacted to another video earlier today in the Palantir video, right? Because I reacted to the Palantir stuff and the CTO, but then I reacted to a bunch of other videos. One of those videos was a gentleman that went on there and says, I'm not willing to pay up in this market, right? And he went all in depth on that. So this myth of like everybody's on the side of super bullishness and feeling great on Wall Street, it's not that way. We still got a very divergent Wall Street. We got some people that are feeling great. We got some people that are a little cautious, and we got some people that are more on the bearish side. They're expecting the S&P 500 to go down into year end. Like the guy I reacted to earlier, he's calling for S&P 500, 5,600 into year end. So he's talking about a downtrending market, right? Even Tom Lee's been incredibly cautious. I think he's starting to go a little more bullish, but he's been very, very cautious going into September. Obviously, it was a great time in the market. Going into October, he was cautious. And, even when Tom Lee's cautious, I think that everybody's got to say, wow, that even he's cautious on the market. So maybe the market's looking out there and the market sees great earnings for 2025. That could be a potential. And I brought this up as a point in the reaction channel earlier today in that video. I said, what happens when the bottom 50% is in a lot better financial situation because they haven't been sliced and diced by inflation, which could be a situation that plays out in 2025. Unemployment in the fours, which means wages will be good. But additionally, you don't have all that crazy inflation that slices and dices people. Well, suddenly people could have a lot more disposable income around. And people have more disposable income, we know what they're going to do with it. They're going to spend it, which means they could buy something at Nike, right? They could buy a new Apple product. They could, buy another Frappuccino at Starbucks or whatever it is, right? It's just more money to be spent in the economy in general. People are in a better financial situation. I think that's something you got to at least consider, and I don't think enough people are considering about the bottom half and the spending that could come from that, because a lot of folks just got hit so hard by 2022 inflation, 2023 inflation into the very beginning of this year that I feel like there's a decent probability, since real wages could uptick quite significantly over this next 6 to 12 months, that actually people might be in a pretty good place when it comes to kind of the lower income brackets. And we know that the higher income brackets are making bank still on treasuries, making bank on savings accounts, right? And making bank in the stock market, and real estate prices have held up pretty good.
As good as, is it really going to be able to go further from here?
And you really feel like everybody is sort of now on one side of the boat?
It feels like, valuations would suggest that, sentiment would suggest that, but call ratios would suggest that.
Yeah.
I feel very much like a lone, more cautious investor at the moment.
I mean, there are reasons to be bullish, no? That's what they say. Fed's cutting, economy's much stronger at this point than people thought it would be. And we're just at the first stop on the train tracks of these cuts.
Right. Well, the question...
And also remember, what stocks are really doing that great? It's the big techs, it's those, but look at the earnings of those companies. Pretty much all those companies have revenues going up double digits or triple digits, earnings per share going up double digits or triple digits for those companies. So, and they're not a lot of those stocks are trading at forward P's in the 20s and 30s, which is not at all crazy for those sorts of companies. So it's hard to even make a case that those are super overvalued. Then you go down to the dividend and value stocks. Many of those stocks are still trading at or near multi-year lows. Not like 52-week lows. I'm talking multi-year lows. I'm talking they're trading at or near 3-year lows, 5-year lows, 7-year lows, 10-year lows, some 20-year lows. So when you think about it from that perspective,
what's priced in, right? So if we look back at, go back to where the market bottomed. The market bottomed at the end of October 2022. We were worried about the economy getting worse and the Fed having to cut at some point. We had infrastructure spending ahead. We had onshoring spending ahead. We had AI excitement ahead of us. The market was at 15 times then. Here we are, 2 years later, market's at
21 and a half times.
You can't play that game. You can't say, well, at this time it was bad. If I played that game, I'd be saying that all the time. Look at how the market was valued PE-wise back, in my first few years of investing. I got in the market end of 08, going into 2009. Look where PE ratios were trading at in the stock market back in 2010, 2011, 2012. And imagine I'm like, well, the market's richly valued. So you know what? I would have missed the run from 2013 to 2024. So I just don't think that's a good case of saying, well, it used to be valued here, PE-wise. No.
AI spending has already massively taken off. Going to continue
it's not over.
Strong. It's not over, but is it accelerating from here?
Spending?
No.
Spending accelerating.
Maybe.
Growing at a faster pace than it's grown so far. I'm not sure it's going to grow at a faster pace. It's going to continue to grow a lot. There are going to be a lot of dollars, but is it going to grow at a faster pace than it's grown?
No.
I don't know. Are we going to see infrastructure spending grow at an
Not for
accelerated
Nvidia,
rate from here versus what we've seen over the past couple of years? From what I'm seeing, it looks to be more stable, right? And then in terms of Fed rate cuts, yes, we are here with rate cuts, which should be stimulatory. The only reason it's taken this long is because the economy's been better.
Yeah, for good reasons.
For good reasons. But what we've had the market front run those rate cuts, right? So you look at many industrial stocks, you look at stocks in the housing sector, you look at stocks in trucking, they're trading at near all-time highs on potentially depressed earnings with the expectation that rate cuts are justify the valuations. But then when you get those rate cuts, how much upside is there to the stocks from there?
Okay. That's not fair. I mean, housing, for instance, she brings up an example, makes it sound like the earnings are bad or something. Their earnings are phenomenal. Many of those companies are reporting all-time highs in their net incomes, their earnings per share. They're on fire. So that's just not a reality in terms of, look at Toll Brothers. Look at Toll Brothers' net income. Have you ever seen it that high before? Look at their earnings per share. Have you ever seen it that high before? It's ridiculous.
A lot of it is just in the market.
They're making money hand over
What
fist.
areas of the market do you like? Because when you sat down and you said you kind of uncomfortably the bear out of the group thus far on the show, it's not like I don't like anything, but what do you like?
Yes. Well, we tend to have more of a barbell approach to our portfolio where you have kind of those steady, kind of compounding ballast positions, reasonably priced, not as cyclical, and then cyclical opportunities. So on the kind of more ballast side, we continue to like the telecommunications companies. I don't think many people are aware that actually you've had two of the major wireless carriers in the U.S., their stocks were around 30% this year. They've massively outperformed the market, but they're still quite cheap at 7 to 10% free cash flow.
They did underperform prior to that, didn't they?
But the whole point is what has been the opportunity for this year and what's the opportunity from here. And I think people are really...
The warning I'll give you in regards to those stocks are they're heavily debt-ridden, and we're still in a higher interest rate environment. They're still going to be in a higher interest rate environment for at least the next 6 months, if not 12 months.
Appreciating how this industry has become more consolidated. Family plans are creating a stickiness factor where they're not having to spend as much to keep you. Churn is coming down. And also each of them has a secular growth story, whether it's fixed wireless or fiber. That has a high ROI for them to build out their broadband businesses over time. Look, very slow growth, but just way too cheap. Solid, steady businesses. If rates are coming down, where can you get a 7 to 10% return to shareholders every year? So we like that. We also like areas in cyclicals. So we're more cautious on cyclicals that we feel like are pricey in a lot of Fed cuts. But there are still areas of cyclicals that are very cheap.
Alrighty. Appreciate y'all joining me as always. Thanks so much for being here, folks. If you're looking to apply, join our private stock group, private wealth group, as well as get access to 1000xstocks.com. You can click the pin comment down there, fill out an application. We'll see if we can get you access to all that maybe later on this week or next week, learning how to scale your portfolio up to 6, 7, 8 figures and beyond. Much love and have a great day.